Hello guys, welcome back to our segment today, a continuation of what you're doing earlier on. Recall my good students in our last class, basically we had looked at a concept of Altman Z-score, and today's session is just a continuation of what you're doing under the quantitative methods that we normally tend to use to predict our corporate failure. So, in today's class, we mentioned that when you're clearing our last class, we mentioned that we'll be introducing this method known as what? Springate Model. So that's what I want us basically to introduce in our session today. And of course, time will allow us also do a question in relation to that. So here we are talking of Springate Model. So you'll find that this model of predicting corporate failure, you'll find that it is more of Altman's Z-score. So here you'll find that it is also used in companies which are not within the manufacturing industry. Like for Altman's, basically we mentioned that it is always used majorly to predict bankruptcy in the manufacturing sector or industry. But for Springate, you'll find that at this point, this cuts across. It's not only in manufacturing firm, right? Or rather outside manufacturing firms. So what is the most important thing that you should be able to understand anytime you're talking of a Springate model? Anytime you're talking of Springate model, my good students, at this point, you'll find that this model, of course, which we mentioned, can also be referred to as Springate Z-score model. Springate Z-score model, because we've said that the whole idea is more of what you did under Z-score. Okay, so the difference here is that when you are talking about our financial, basically our financial ratios, in this case we find that it has a smaller set compared to Z-score, because at this point, depending on what you are given, many times you can use basically aspect of four ratios. It uses four financial ratios. It uses four financial ratios. It uses four financial ratios. Remember, like for Atmas, which was using five, Springate uses four financial ratios. So you'll find that at this point, it relies majorly on these ratios that we are talking about. Of course, we'll be talking of these ratios. Talk about basically honest. Yeah. Talk about these honest. Honest. You'll wonder, Mwalimu, now what is honest? So let's simply, basically, you'll find that we are looking at the working capital here. Working capital over our sales. These are the ratios. O basically stands for operating profit. Operating profit. And anytime, of course, whenever you're talking of operating profit, ideally, we're talking of earnings before interest and what? And tax. Over sales. Talk about net profit. This is, of course, net profit after tax. We divide by our aspect of current liabilities. That is, we take, of course, that one divided by our current liabilities. Net profit before. These are literally net profit, of course, before tax, not after tax. Net profit before tax. We divide by our current liabilities. Whereas this one, of course, is the same. Talk about sales. Divide by our total assets. See? So here, we are looking at what? We are looking at basically Springate. So that is to say, at any given point, whenever we want to achieve basically this model, ideally, we'll be talking of our Z here to be, assuming this one is x1, x2, x3, x4. Or simply you can use A, B, C, and D. The beauty part is that for the purpose of examination, you'll always be given this model. So we are talking about aspect to do with 1.03A. We add 3.07B. We add 0.66C, and finally we take 0.4D. Okay, so these are Springate model. Where A is simply working capital of sales, O is simply operating profit, that is our earnings before interest and tax over sales, whereas NE is net profit before tax. We divide by our current liabilities, and finally we're talking of D to be sales of our total assets. Very important for us to always understand that. More the same as what we had mentioned on aspect of Altman Z-score. So no need of repeating the all elements, but ideally you'll find that the first case of working capital, ideally we are talking of aspect of liquidity, right? It measures the company's liquidity. Then of course all these other elements, it's just the same as what you had mentioned earlier on under Altman Z-score. So you'll find that for this case, some other models which will give us the same case for Springate, we can as well talk of the following model, which in this case, basically, we are looking at it in terms of our Z-score here, B equal to 1 times A plus 3.3 B plus basically 1.0 C. Okay. Some books might also define Springate in that mode, whereby I'm looking at 3 financial ratios, where these 3 financial ratios, basically, number one is aspect of A is simply a working capital. We divide by our total assets. Talk about B, which would give us retained earnings. Divide by our total assets. And finally, C, we'll be talking of earnings before interest and taxes, EBIT, which is literally our operating profit. Divide this one by, of course, what? Our total assets. See, this model can also be used in relation to what? Springate model. So depending on what you are given to use, kindly use whatever that the examiner has given you in your paper. Now, what about aspects of advising, or rather measuring our Springate model? So just like Z-score, in this case, we'll be measuring it using some scores here. And these scores literally are as follows. These scores are literally as follows. So we are looking at a score between 0 to 1.1. Talk about 1.1 to literally 2. So any Springate score that basically it is between any Springate score that you'll find it to be basically between this area. It will indicate that this firm has 100% chance of failure, 100% chance of bankruptcy, 100% chance of bankruptcy. Between a score of between 1.1, this is a 50% chance of bankruptcy, which we're referring to it as a gray area. And of course, more than 2, then there's no chance of failure. There's no chance of failure completely. So these are what you're referring to as a Springate model, a very important model that will always tend to help us to understand this concept very, very clearly. So after this concept, my good students, I want us to basically make sure that we've cemented this knowledge by looking at a question in your past paper. This question was tested basically in December 2021. Question number 3. I've shared the question with us, and I believe the question is very visible. Believe me that the question is very visible. See what you are asked there. See what you are asked. We are told that the following data relates to Kaban Limited, a company that operates basically in the manufacturing sector for the year ended at 1st December, where I'm told the company is currently paying interest on a long-term debt instrument amounting to 905. That's the interest that the company is paying per year, and that the company total liabilities is constituted in the ratio of 2:5 between current and non-current components. Okay, so required using a Springate model, assess the financial health of the company. Then note the Springate model takes the following form, which our good examiner has given us there. Then I'm given A, B, C, and D, right? So given such a question, of course, there's no hard task there other than us to just copy and paste. Kuna kazi, no work there, no work there, no work there, no work there. So where are we going to start from? Where are we going to start from? That will be very, very easy, and I believe by now you guys, you're almost done with that question. I believe you guys by now, you're almost done with that question, right? So these are what you should do. Believe that all of us have access to that question. So that question examiner has given us a model to use. December 2021. Question number 3. So I'll squeeze this question of ours. So the first thing that we should note is that we're given our model. The model that our good examiner has given us here is very simple. He has told us that for us to achieve Z according to the Springate 1.03a, we add 3.07b, we add 0.66c, we add 0.4d. Given such a question as simple as that, then see how the examiner simplified for us. He's telling us that A, for us to achieve A, I'll be taking our net working capital we divide by our total assets. Okay? Net working capital are we given? Look at that case. I was given the net working capital of minus 1777 divide by the total assets. If you can check our total assets, I was given there to be 49,579. Kindly confirm what you are given. So we can agree and say that our A will be negative 177 divided by 49,579. This will give us negative 0.03. Negative 0.0358. Talk about B. Our B, a good examiner here, he has told us that our B will be equal to what? My B in this context, I'm told that it is equal to operating profit we divide by total assets. Again, copy pasting. Operating profit in our question, I was told that my earnings before interest and taxes we were given to be 2605 there. Look at that question clearly. Look at that question, right? So, earnings before interest and tax, that is operating profit that we normally tend to talk about. And recall you mentioned that, right? So, my operating before interest and taxes, EBIT, 2605 divided by total assets, 49,579. So this should give us our value of 2605 divided by 49,579, right? To give us 0.0525. Talk about C. C, if you can check there, a good examiner has told us that C, I'm having net profit before taxes. We divide by, of course, our current liabilities. So what will we be having? Our net profit before tax will be net profit before tax. We should be having what? We are given earnings before interest and tax, EBIT. I was given to be 2605. If you can check clearly, we're having our interest, which we are told our interest amounted to how much? 905. So therefore, our earnings before tax, net profit before tax, I should be having 2605 minus 905 to give us 1700. So that should give us net profit before tax. Current liabilities, what were we told? We are told in that note that per year in the company, 905 per year, that is interest. The company's total liability is constituted in the ratio of 2:5 between current and non-current asset liabilities. So current liabilities to non-current liabilities, we are given this ratio of 2:5. Yeah. So what will be our current liabilities. My current liabilities, therefore, we should be talking of 2/7 times the total current liabilities there, which was given. The book value of total liability is 50.44. So that should give us 2/7, 50.44, to give us a value of 14.41. So therefore, we can agree and say that my C will be 1700 to give us 1.1796. C. What about our D? D, a good examiner is telling us that you're talking of our sales of total assets. So therefore, my sales, we had 25,678. We divide by total assets, 49,579. So that should give us what? 25,678, 49,579. To give us 0.5179. We have achieved all our variables in relation to A, B, C, and D. The next step will be simple because I'll be taking our model now, which in this case, we are having our Z to be equal to 1.03 times A, 0.04. We take our B will be equal to 3.07. We multiply by, remember this is negative, plus 3.07 we multiply by 0.05 plus 0.66 we multiply by C, 1.18. Then finally we add 0.4 times 0.52. So this should give us our Z to be equal to what, my good students? My Z therefore should be having 1.03. 1.03 we multiply by 0.04 negative 0.04, 3.07 we multiply by 0.05, 0.66 we multiply by 1.18, 0.4 we multiply by 0.52. So I'm having my Z here to be 1.2, right? I'm having my Z to be 1.099 something. Kindly confirm if we are on the same page. Confirm if we are on the same page. I'm getting 1.0991. Kindly confirm if we are on the same page. That is our Z according to Springate model, right? So look at what we mentioned. What will be the status of this company? The status of the company here, what will we be having? In this case, we'll find that, given the fact that at least it is 1.1 at least, and in this case, we'll find that it is on a gray area, right? There's a 50% chance that there's a 50% chance that this company might went to bankruptcy. There's a 50% chance that the company might went to bankruptcy, given the fact that we have that range in what Molimu told us, 0 to 1.1, 1.1 to 2 and above. So this is, of course, anything below 1.1. Anything below 1.1, anything below 1.1 is 100% chance that the company will go to bankruptcy. But a score of 1.1, between 1.1 and 2, that is to say, there's a 50% chance that the company will go to bankruptcy, basically on what we mentioned, right? So literally, you can remove this portion. So you'll find that on this case, if at all you are to mention something, you'll find that the firm's financial interpretation is good, since basically in this case, I'm having a Z of 1.1, which ideally here you'll find that it is above, or rather it is on 1.1. So literally there's that 50% chance the company might go to bankruptcy. So that is what we are supposed to do whenever we are dealing with what? The Springate model. Remember the other model that has remained, basically in this case, for the purpose of our studies, we mentioned several, but for the purpose of our studies, we'll be looking at, of course, the other model, which is purely now qualitative. And this model, we normally refer to it as what? We normally refer to this model as Argenti's score model. Argenti's model. So these are what you're going to look next. So this one, basically, it doesn't have any computation. This one is purely theoretical. Actually, what I'm going to do, I'm going to give you notes on this so that at least you go through the notes clearly, because there's no computation there. So to that point, guys, thank you so much. We'll meet in our next class. I think our next class will be introducing a whole new chapter, because like we don't have any other question for Springate, which ideally we can practice with, but I'll be looking at more questions for the same, so that you guys, you can always test yourself. To that point, thank you so much, and we meet in our next session. Thank you. Bye.